I pulled up my semiconductor watch list this morning, and I want you to picture exactly what I saw, because the picture matters more than the numbers. Row after row after row, all lit up red. Not one green line anywhere on the screen. The companies that design the chips going into every AI data center on Earth, red. The companies that manufacture the memory those chips depend on, red. The equipment makers building the machines that build the machines, red. Even the smaller suppliers just riding the coattails of this whole ecosystem. The ones nobody outside the industry has ever heard of, red right along with everyone else. It looked less like a stock screen and more like a heat map of a fever. And when you see that much red at once, stacked on top of itself, 30 straight days of it, your gut does something specific. It doesn't calculate. It doesn't pull up a spreadsheet. It just says quietly but firmly, something is breaking. So that's the real question we're sitting with today. Is the AI semiconductor trade finally cracking under its own weight? Or are we watching the most expensive, most hyped, most talked about corner of the entire stock market simply take a breath before it climbs even higher? Because those two stories look almost identical from the inside. A chart doesn't come with a caption telling you which one you're looking at. You have to do that work yourself, and most people never do. Stick with me, because by the end of this video, you're going to know exactly what separates a real bubble popping from a healthy pullback, and which one this actually looks like right now. There are 3 things that tell the difference, and underneath those 3 things are 4 forces driving the sell-off and 4 signals I'm personally watching before I make a single move with my own money. Let's start with what the numbers are actually telling us, because the numbers say something very different from what the headlines are going to say. This is the PlayStation 5, a sleek, futuristic box hiding the result of one of the most ambitious global manufacturing operations ever attempted in consumer electronics. From the outside, what happening right now is different in kind, not just in size. The selling has spread across the entire semiconductor food chain at the exact same time, like a rumor moving through a crowded room faster than anyone can verify it. The chip designers are down. The memory manufacturers are down, the equipment makers are down, the smaller firms that just supply parts into this ecosystem, companies most people couldn't name if you paid them, are getting pulled down right alongside the giants. Here's why that distinction actually matters, and it's the first thing worth sitting with. When a single stock falls, that's a story about one company's execution, one earnings miss, one product delay. When an entire sector falls together in lockstep on the same days, that's not a story about execution anymore. That's a story about sentiment, and sentiment moves at a completely different speed than fundamentals do. Fundamentals, the actual revenue, the actual profit, the actual demand for chips, those things shift slowly, quarter by quarter, filing by filing. Sentiment can flip in a single afternoon, off of one headline, before a single earnings report has even come out to confirm or deny it. Think about what that actually looks like from the inside of a trading floor. It's not a boardroom of executives calmly reevaluating a business model. It's more like a crowded exit during a fire drill that turns out not to be a fire. Nobody wants to be the last one still holding a position if everyone else in the room decides to leave at once. So the moment enough people start moving toward the door, more people follow, not because they've done new research, but because everyone else is moving. That's not a knock on this sector specifically. It's just how every crowded trade behaves once too much money piles into the same handful of names at the same time. It doesn't take a piece of bad news to trigger the stampede. Sometimes all it takes is enough people quietly deciding in the same week that this is a good time to lock in the gains they've already made. So why is this happening right now, specifically? I think there are 4 separate forces pulling on this sector at the same time, and it's worth walking through all 4 because each one tells you something different about how worried you should actually be. Number 1. Valuations got stretched past what the underlying businesses could realistically justify. Some of these AI-related names doubled in a matter of months. A few tripled. When a stock triples that fast, the market isn't pricing in this quarter's earnings anymore, it's pricing in 3, 4, 5 years of flawless future growth, all pulled forward into today's price tag. That's a bet with almost no room for error built into it. And when the pace of good news slows down even slightly, when growth is merely excellent instead of miraculous, the air comes out of a trade like that fast, because the price was never really about the present. It was about a promise. Number 2. Profit taking. Plain and simple. After a run like the one this sector just had, the large institutional investors, the pension funds, the hedge funds, the people managing money in the billions, don't sit around admiring the chart. They lock in gains because that's literally their job. And when enough of those large holders decide to sell in the same stretch of weeks, that selling pressure doesn't stay contained to one stock. It ripples through every related name in the sector, whether that specific company actually did anything to deserve the sell-off or not. Good execution gets punished right alongside bad execution, because the selling isn't really about any one company anymore. Number 3. The market has started asking much harder questions about AI spending itself. Hundreds of billions of dollars have poured into data centers, GPUs, and AI infrastructure over the last few years. And for a long stretch of time, the story alone was enough to move these stocks higher. You didn't need proof, you needed a narrative. That's changing. Investors who were happy to fund the vision are now asking to see the receipts. They want proof that all that spending is converting into durable, repeatable profit, not just another slide in an investor presentation promising it eventually will. That shift from believing the story to demanding the numbers behind the story is uncomfortable for any sector living on hype, and this one has been living on hype for a while. Number 4. The macro backdrop simply isn't cooperating. Higher interest rates make it more expensive for these companies to keep expanding, and they make investors less patient about waiting years for a payoff instead of taking a safer, more immediate return elsewhere. Geopolitical tension and export restrictions on chip technology introduce a kind of uncertainty that no earnings report can fully price in, because it depends on decisions made in government buildings, not boardrooms. And signs of a slowing global economy land hardest on exactly the kind of expensive, high-growth names that need everything to go right to justify their price. Semiconductors sit directly in the blast radius of all 4 of these forces landing at once, which is part of why the sell-off feels so broad and so sudden. Now here's the part that most headlines covering this story are going to get completely wrong, and it's the part that actually matters more than any of the 4 reasons I just walked through. A falling stock price and a bursting bubble are not the same event, even though they can look identical on a chart for weeks at a time. Every major bull market in history gets interrupted along the way, not once, but repeatedly on its path to new highs. The Nasdaq has corrected hard more than once during its biggest, longest runs, and every single time, in the moment, the headlines called it the end. Go back and actually read the coverage from those weeks. The language is almost interchangeable. The bubble has finally burst. The party is over. And every single time, eventually the underlying trend reasserted itself and carried right past the old highs, leaving that panic looking, in hindsight, like noise. Even the company most people would point to as the poster child of this entire AI trade has dropped more than 20% inside a long-term uptrend more than once before going on to set new records months later. If you'd sold during any one of those drops because it felt like the end, you'd have missed the recovery entirely. That doesn't mean this particular pullback is guaranteed to end the same comforting way. History rhyming isn't a promise. Some sectors really do get overhyped past the point of recovery. Some companies really do fade for good once the story stops being enough to carry the stock. The difference between a name that comes back and a name that doesn't usually comes down to one thing: whether there was ever real cash flow underneath the story in the first place. That's the lesson from every real bubble in market history, not just the tech crash at the turn of the millennium. The companies that had actual customers, actual recurring revenue, and actual profit margins eventually recovered and went on to dominate their industries for decades. The companies that only had a narrative, a slide deck, and a rising chart quietly disappeared once the money stopped flowing in on faith alone, and nobody remembers their names today. So a red month on its own tells you almost nothing about which of those 2 outcomes you're actually looking at. The question isn't, did the price fall? Prices fall constantly for reasons that have nothing to do with whether a company is healthy. The real question, the one that actually separates a bubble from a breather, is this: did the reason you believed in these companies in the first place actually change? Or did the price just get cheaper while the business underneath it stayed exactly as strong as it was a month ago? That's what I'm personally watching for over the next few weeks, and I'd break it into 4 specific things. First, is AI infrastructure spending actually slowing down, or is it still happening at full speed behind the scenes? Are the big cloud providers still placing massive orders for GPUs and building out new data centers, or are they quietly pulling back their commitments while the headlines are distracted by the stock price? That spending is the actual foundation this entire trade is built on, and it moves months ahead of any stock chart. Second, earnings. Not guesses, not vibes, actual reported numbers. Are these companies still growing revenue at a real pace, or is growth starting to stall out underneath a stock price that hasn't caught up to that reality yet? A stock can fall for weeks before the earnings finally confirm whether the fall was justified. Third, margins. Are these companies still making real, expanding profit on every chip and every server they sell, or is competition starting to eat into what they're able to charge? Rising revenue with shrinking margins is a very different story than rising revenue with margins holding steady, even though both can look similar on the top line. And fourth, institutional buying, which is often the most honest signal of all. If the same large funds that were selling a few weeks ago start quietly stepping back in and accumulating shares again, that tells you a great deal about how the smart money is actually reading this pullback once the initial panic settles. Big institutions don't move on headlines or on emotion. They move on data, often weeks after the rest of us have already reacted with our gut. Watching where that money flows next is usually more useful than staring at the price itself, because price reacts to fear immediately, while positioning reveals conviction slowly. Here's my honest take, for whatever it's worth. I don't think we're watching the semiconductor industry collapse. I think we're watching the market reset its own expectations after getting a little ahead of itself, the way it always eventually does after any trade gets this crowded, this fast. Picture a runner who sprints the first mile of a marathon at a pace they could never actually sustain for 26 miles because the crowd around them is sprinting too, and it feels wrong to fall behind. Slowing down in mile 2 isn't quitting the race. It's correcting a pace that was never sustainable in the first place, so the runner can actually finish strong instead of collapsing at mile 10. From the outside, that slowdown looks alarming. From the inside, it's often the healthiest thing that could happen, even though it feels uncomfortable in the moment it's happening. That's what a real correction tends to look like from underneath, as opposed to a real bubble bursting. The companies with genuine earnings, genuine cash flow, and a genuine competitive edge that competitors can't easily copy are going to separate themselves from the ones that were only ever along for the ride on hype and momentum. The weak names, the ones that were priced for perfection with nothing but a story behind them, may keep sliding for a long time, and some of them may never fully recover. But the strong ones, the ones with real businesses, sitting underneath the ticker symbol, they might simply be going on sale while everyone else is too busy panicking to notice. So go back to that image from the start of this video. The entire watch list lit up red, not one green line anywhere. That image felt like a verdict. It felt like the market handing down a final answer. But red on a screen was never actually a verdict. It was only ever a question, dressed up to look like an answer, because fear is more convincing than nuance, and panic spreads faster than patience ever does. The real verdict doesn't come from the color of the chart this week. It comes from earnings reports still weeks away, from spending commitments that haven't been canceled, from margins that haven't actually collapsed, and from institutional money that hasn't actually fled for good. Everything that will decide who's right in this story hasn't been written yet, no matter how final 30 days of red might feel right now. So I want to hear from you directly. Looking at everything we just walked through, does this feel like the start of a real semiconductor crash to you, or does it feel like the market handing patient, level-headed investors another entry point before the next leg higher? If this breakdown helped you separate the actual signal from the noise, do yourself a favor and hit like on this video and subscribe for more breakdowns exactly like this one.